You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody. That music means it's time once again for the Advisor's Option, the program here on the Options Insider Radio Network, where we break down all the happenings, the goings-on, as well as some great education and how to actually use these options products for all of you busy advisors and asset managers and everyone else who's running around. Sometimes you're a little bit too busy handling your own business, handling your own clients to be able to sit back and keep track of all the developments in the world of options and derivatives, as well as, of course, learn how to actually use these things in your clients' portfolios. My name is Mark Longo from the optionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network, coming to the end of yet another great year here on the network, where we produced quite a few fun programs, including many, many archived episodes of this here program, The Advisor's Option. And the best place to go if you want to go check out all of our extensive archives, going on 9 years. In January, it'll be 9 years worth of archives. So literally thousands of hours of great options content for you guys up there to peruse. And probably the easiest place to find all that is, of course, our main online destination, theoptionsinsider.com. Click on the Options Radio Network tab, top left corner of the page, and you're pretty much off to the races from there. You can download, you can stream pretty much every episode we've ever produced all the way back to 2007. So you've got some options there, pun intended, for your listening pleasure. Of course, also available on all the major platforms, iTunes, TuneIn, Stitcher, etc., etc. You can even grab our mobile app, available for iOS and Android if all of that is too much work for you. Even available on the burgeoning Amazon Fire OS. So we haven't left anybody out. And if we have left you out in some way, shape, or form, let us know. And while you're reaching out to us, of course, send us your questions, your comments. We love to hear from you guys. And joining me on the program, as always, my Advisor's Option co-host, Mr. Randy Swan, the co-founder of Swan Global Investments. Randy, welcome back to the program. And where are you beaming in from this episode?
I'm glad to be here today. I'm actually down in Puerto Rico right now, looking forward to spending my first Christmas down here. And then after that, I'm going to move to Durango at the end of the month to get some skiing in before my kids start back in school.
Nothing says Christmas like some nice tropical weather, am I right?
Exactly.
All right. And we are also joined by a newcomer to this program, even though he has been on some of our other episodes in the past. You may remember him, listeners, for those of you who jump around the dial here on the Options Insider Radio Network, from his appearances over there on our Volatility Views program in his previous capacity over there as the risk manager at Blue Capital. He has since moved on, started an interesting new venture that is very much aimed at this audience, as well as, of course, the active high-end retail audience. He is Mr. Ewan Sinclair, the co-founder of FactorWave. Ewan, welcome to the Advisors Option Program.
Thanks very much. It's great to be here. I wish I was somewhere as warm as Puerto Rico.
Well, we can't all be as lucky as Randy, just jetting around the globe for hot spots hither and yon. Some of us have to be here in the old Options Insider Radio Network HQ, holding down the fort, and you, of course, are also in Chicago. Like I mentioned, you had a little bit of an evolution in your career path. Doing something I tend to like here is taking a lot of the things that you've learned and incorporated in your many years over there as a volatility-oriented risk manager, and taking a lot of that now and applying that in an interesting new venture called indeed FactorWave, which one of the reasons we brought you on this program is it is very squarely aimed at the asset manager, financial advisor type audience, and trying to help incorporate a lot of the things you learned, particularly volatility-based things that you learn, as well as some other low-hanging fruit indicators and things, and incorporate them in an easy-to-use manner for lots of the advisors and asset managers out there. Is that a correct assumption, or am I putting words in your mouth? I'll let you describe your own venture here for our listeners there, Ewan.
Well, thanks. You did a pretty good job, actually. What we're trying to do is take a lot of the research that's been done in both big hedge funds and in academia over the last 30 years and democratize it, bring it to the smaller investor, the smaller investment advisor, high net worth individuals. So things that, for example, the value premium's been well understood, but now we understand better how it relates to quality of earnings, how it relates to low volatility, how it relates to the size factor. So these things have been well studied, but they're not really well available to people. And so one of the reasons I got into this is I really wanted this for my own use. And when I looked around at the services were out there, I just didn't really see anything that was what I needed. So we decided to build it.
Isn't that always the entrepreneurial way? You don't see in existence what you want, so you decide to create it. I very much can empathize with that way of thinking. Look where it led me, and all of the crazy madness that has ensued over these 9 years. But I wouldn't trade them for anything. I have a feeling you're going to be saying the same thing. Who knows? A couple years, 9 years, who knows how far down the road. But always an interesting adventure, an interesting journey. And speaking of interesting journeys, it's time for us to start ours by diving into the Buzz segment.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, like the man said, this is the portion of the program where we break down some of the interesting developments, recent developments in the world of options and indeed derivatives, for those of you out there who may be, like we said, too busy running your own practices to keep an eye on this sort of thing. And there's pretty much been one really major development since the last time we all gathered together here on the old Advisors Options program. And it started with a lot of rumors that there was going to be a big impending crackdown from the SEC on the use of the dreaded D word, derivatives, in funds. So we saw a lot of noise coming out of the SEC that was indeed going to take place. And then last Friday, we did indeed actually see that come to pass. And essentially, what the focus of this quote unquote crackdown was on this proliferation we've seen in recent years of these levered ETFs and ETPs out there, these 2x, 3x, bearish, bullish, inverse, whatever type of levered products out there that purport to offer these levered type exposure to the underlying. Of course, at the end of the day, listeners, you can probably guess how they deliver that. They, of course, use primarily options, sometimes futures, but primarily options. And so there's been, whenever there's a notion, the conflation in the eyes of many regulators of derivatives and mutual funds or things that are aimed at the retail public, they tend to want to crack down a little bit. And that's exactly what they did recently. They had a vote, and they came down. Essentially, there's only 4 commissioners there right now. Some people in the industry were even pushing for them to delay the vote until they had a full panel. But c'est la vie, they went ahead anyway without their full complement of 5 commissioners, and essentially have restricted much of the use of derivatives in a lot of these types of funds with some pretty straightforward, some may say contentious rules. And under these new regulations, I shouldn't say regulations yet because it's out for public comment and it's going to get a lot of comment as we've seen already. But the new proposed regulations would limit the leverage a fund can derive from quote unquote derivatives at 150% of net assets. Would also require most fund and fund managers to hold significantly more collateral against potential losses under the rules. They're also changing a little bit of what could actually be used as collateral under the current guidance they have right now. They can pretty much use any type of liquid security to cover that collateral, those margin type payments. Of course, one of the pushbacks against that was, well, if they're losing money in some of their other holdings, they could very well be losing money in those liquid holdings they're using as margin or collateral as well. Therefore, they're not worth as much. So they're going to change that as well so that they have to carry enough cash or cash-like instruments to cover that margin payment and that collateral type payment. And also we saw these funds that hold derivatives can hold derivatives with a notional value of no more than 300% of net assets. And they also did some research into the space themselves, saying that most funds, this is something we've actually lamented on this show, most funds still don't make extensive use of derivatives, with only about 4% of funds having exposure that exceeds this threshold they're laying out here, about 150% of net assets. But still, they felt it was warranted for them to come in and put these stark guidelines in place going forward. Again, this is only comment period, so this is not rule of law yet, but if it goes through the way it is, it's going to have a lot of sweeping changes for this the derivatives and the fund landscape. Randy, we'll start with you. Obviously, you're active in both the options world as well as in the mutual fund world. So you have a couple of different dogs in this fight. And I've heard a lot of interesting feedback on this proposal. Some people saying, we welcome the SEC kind of coming in and trying to rein in what has essentially become kind of the Wild West of these levered ETP products that could give more structured, more risk mitigating type products like yours, the overlay strategy, maybe give that a bad name by kind of painting them all with the same broad derivatives brush. And I've seen others, kind of myself included, quite frankly, who have seen enough crackdowns on quote unquote derivatives to know that even with the best of intentions, there's a lot of unintended consequences because the regulators tend not to really understand this space too well. And so even with the best of intentions, they sometimes cause that butterfly effect, which we won't know until these regulations actually go into pass what the actual impact of them is. So a lot of people falling on different sides of this argument. Randy, you have, I guess, like we said, have many different dogs in this fight. What's your viewpoint first on the overall recommendations coming out of the SEC, and then B, maybe taking a step back from that, looking at it more from a 10,000-foot perspective, your general viewpoint on the SEC's, crackdowns on derivatives in general and also in this one in particular?
Generally, I always default to the position that I would like to have more options for investors. So I'm very leery to have the SEC come in and say that, hey, you don't really know what the risk you're taking on in a certain product. I know my personal experience in terms of launching several mutual funds, it's always come back to you have to really be very legalistic in what you lay out, what the risks are, and I think that would apply to any of these funds. So I have a hard time believing that most people are using them don't understand those risks. So I'm going to say from a 10,000-foot view, I'd like to have more options. More freedom is better than less freedom almost all the time. So from that perspective, I think it's great. On a personal level, I don't think this is necessarily going to affect me. Of course, we haven't seen really how this is all going to be laid out, but I don't think on a personal level, as it relates to what Swan does, this is going to be a big problem for us. In terms of trying to always protect the investor, I always go back to the same thing. Investors need to be reading the material and deciding how that fits into their individual portfolio, whether something like this works or not. So I'm going to side on the side of freedom.
Siding with freedom, always a good way to go. And you're not too concerned about these, perhaps some may say, arbitrary strictures they've imposed, essentially saying 150% cap on leverage, and I believe it was about 300 on the net, 300% of net assets. These seemingly arbitrary levels. I mean, obviously they don't really pertain to you guys because you guys don't. You're not swinging for the fences like these levered ETP products. But still, the notion of any sort of arbitrary limit, some people may push back on. That doesn't concern you at all?
Well, once you get beyond the big picture concept of freedom, then I think you're right. You get into logistical issues of being arbitrary and what's crossing the line, what's not crossing the line. There's always unintended consequences whenever you go down a path like this and set up some type of rule or regulation. Clearly, people would be able to change their structure or structure products that meet within those guidelines. That's definitely a possibility. But yeah, I think it's problematic to solve the problems. I mean, I have a general rule that governments usually screw things up more than they help things at the end of the day.
I think there's a definite libertarian bent to a lot of the participants on this network, at least. It seems to just work out that way when you've been around in capital markets for a while. You tend to have a somewhat distant view, shall we say, on regulators and even their best intentions sometimes not playing out the way they anticipate. Ewan, you've been around in the space in a lot of different capacities for a number of years now, of course, very much active in the volatility fund space for a long time, in the risk management space, and also now working and trying to break into the realm of other funds out there, many of which may use derivatives, some of you do not, and they're coming to your platform to learn a lot of these metrics and analytics you were talking about earlier that they can incorporate in their own portfolios and their own strategies. So I'm curious, kind of same question for you, kind of first off, maybe the 10,000-foot viewpoint of someone who's been around the industry for a long time and hearing yet another SEC crackdown on quote-unquote derivatives, and then maybe any specifics about this crackdown, this proposal that may have caught your eye.
Well, yeah, I just want to go on record saying, obviously, I'm pro-freedom as well. Before, it's sort of like saying you're pro-puppies or something, right? I think it's one of these cases where a lot of people believe that we need some more regulation in the industry, but I read through this and it just doesn't seem to be really something that needs a great deal of regulation. I kind of would disagree a little with Randall in that, well, for a start, this does affect me personally, not in the stuff FactorWave does, but I've done pretty well over the last 4 or 5 years trading the various relationships between these levered ETFs and the reference products, as I think we've talked about on your other show. I do also think most people really don't understand them. The number of questions I still get about how these things behave is astonishing, and I don't think most people actually read the prospectus. The question I get, the first level is, why do these things go down when the reference product's gone up and it's 3 times leveraged? And then the second level misunderstanding is, oh, these things always go to 0. And obviously, neither of those things is actually true. I think in terms of like a professional advisory service or as someone running a large amount of money, I don't really know anyone in that space who invests in these leveraged ETFs. So I think for the advisory space, it's probably not going to make a great deal of difference. Where I would get concerned is, I think, and I agree with Randall here, is that, it's right now they're coming for the leveraged ETFs. Who knows what they're going to come for in the future?
Yes, that kind of old caution. Yeah, I'm with both of you, I think, in that sense that, I do agree that that levered ETF side of the space has kind of been like I said earlier, the Wild West for quite a long time. We saw a crackdown a few years ago from just the brokers realizing they needed to tighten up their margin requirements, people trading options on these levered ETFs and ETPs, because essentially they were just getting a second swing at the bat for free. So it's talking about swinging for the fences essentially twice in the same trade. So they cracked down on that, I think, wisely, and tightened up their margin requirements there. And there does need to be some cleanup done in that space, because a lot of these products are constructed so poorly and they don't really deliver at all what they're attempting to do, and a lot of retail is being caught in the middle as a result. Maybe perhaps instead of just putting arbitrary restrictions on use of derivatives, maybe actually try a little bit more of a crackdown on what these guys actually claim to be delivering versus what they actually deliver. Maybe a little bit more value added there. But yeah, I'm also leery of the best of intentions, because that's why we don't call this network the Derivatives Insider Network. The D word is highly loaded, and it's mostly pejorative in the modern era. And so whenever I see people cracking down, quote unquote, on derivatives, the concerns, the hairs in the back of my neck tend to go up, because we know, as Ewan implied, there's probably something else coming very soon, and we probably don't want it. So interesting stuff. If you're out there looking at a lot of these levered funds or ETPs that may directly impact you, because a lot of these may be forced as a result of these rules down the road to perhaps deregister as mutual funds because they won't meet these strict requirements. Speaking of interesting developments in the space, I kind of wanted to get this one mentioned on this show as well. We were debating it recently on our Volatility Views program. I thought it was worth discussing for this audience as well, particularly because the use case for so many asset managers and advisors out there when it comes to options is pretty much hedging in the S&P using put options and put spreads. We're seeing a lot of interesting developments out there regarding what's been going on in the volatility skew out there. And if you're confused about that term, listeners, I encourage you to go back and check out our episodes we've done on this program, as well as, of course, Options Bootcamp and indeed Volatility Views, discussing volatility skew at great length. But essentially, in talking investment skew, which is what applies to the S&P 500, of course, it's the volatility premium that's going to be in those put options versus the call options. And there's many reasons, a lot of research as to why that relationship exists. And it's particularly steep these days out there in the land of S&P 500 skew. And a lot of people have been debating why that may be. Well, of course, it could be the market is top heavy right now, and that certainly is a reason to buy some puts and have some puts in your back pocket. So that certainly is contributing to it. There's also an interesting piece recently coming out of, I believe it was Bloomberg, where they talked to some folks who did some research over there at Deutsche Bank, saying that they believe, looking at their research, that the actual reason the skew is so expensive, aka the puts out there you may want to buy and SPY and other products now have become more expensive than they have in recent years, is because of the stress tests that are being mandated. Again, going back to the regulators and perhaps their unintended consequences, these stress tests are becoming more severe and more frequent that a lot of these banks are subject to. So as a result, they really don't have much choice but to hold a lot of these put options and to do it farther out as well. And so that's kind of almost mandating a bit of a premium to the skew out there. And then the third one, which I thought was kind of interesting, something we've discussed a lot here on the network, has been the essentially the exodus, the diaspora, call it what you will, the slaughter, some may say, of a lot of size market makers and liquidity providers in this space, some as a result of regulation and Dodd-Frank. The banks can't really play in a lot of these products anymore, and also on the smaller side out here in Chicago and others, a lot of the firms that used to make markets in these products simply aren't doing it anymore. So these markets are a lot thinner. As a result, if there's fewer firms out there to stand there and actually sell you these puts, aka the offer is going to go up just because there's fewer people out there to sell these things to. There's less inventory available. So maybe interesting to kind of break down these factors. The stress test is certainly something we hadn't really discussed before. We've on the network discussed the market maker impact, the loss of liquidity providers. That's certainly an interesting one. But at the end of the day, it all accretes back to the space and in that these puts are more expensive. Randy, this is probably something you guys have noticed quite a bit out there at Swan because puts are a big part of the defined risk strategy. You guys are playing in a little bit different space. You're not buying monthlies or weeklies. You're out there buying essentially 1 to 2 year type puts and put spreads and then writing other options against it. But I'm curious, if you guys have really been noticing this a lot in your portfolios? As you've been constructing these overlays, have you started to say, "Wow, we're really still paying a lot more for these puts than we used to be"? Is it something you've been kind of noticing yourself? And then B, which, if any, or maybe a combo, do you think is really to blame for this really expensive put skew out here we're seeing in the S&P 500 right now?
I'll answer the second part first. I mean, I think that all three of those are factors to determine the price of options. I think that's the nature of the beast. Our strategy is committed to long-term hedging, so we have to go through the good and bad times. One of the factors that we use to mitigate that is obviously that we're selling options too. So to the extent that we may be paying up for some of the put options, we're obviously selling out of the money puts to create put spreads. So we think at the end of the day, it's a still a good environment to do this. Obviously, being 6+ years into a bull market, not sure where we're at right now. I think we're kind of in no man's land. So at this point in the cycle, it's probably not a bad idea if you're not a systematic or a strategic user of options to consider using them right now. As it relates to us personally, we have noticed that the costs have gone up slightly. Like I said, I don't think it's prohibitive at this point to use those options. But like I said, that's all part of the market cycle, the ebb and flow of the way markets work. So that's how I'd answer those questions.
Yeah, unfortunately, if you believe, particularly the stress test scenario, there may not be a lot of ebb in those puts anytime soon, at least going forward. Ewan, this is obviously your wheelhouse. You spend a lot of time out here looking at the vol skew and products like S&P and others. I'm curious where you fall on this, and which of these, if may or maybe a combo, do you feel is really to blame for this rich level of skew we're starting to see these days?
I think, as with almost any interesting question, the answer is always it's a combination of factors. The one that I've been most familiar with, I think you alluded to, with the market makers under pressure now, there are fewer market makers, and they are being held to tighter risk limits by their clearing firms. So it all really comes down to selling puts involves risk, and the whole market is sort of being pushed to de-risk. So a couple of years ago, when the VIX was very low, I kept on saying to people, well, you expect the put skew to be high now because overall volatility is low. So that's sort of the way it works, because people still want to get some premium for selling insurance. But even as the VIX has come up, relatively significantly into a different range now, the skew is staying very high. And I kind of think that's the new normal, purely based on as we're seeing, everyone's being pressured to de-risk. There's just a lot fewer people out there prepared to sell volatility, or prepared or allowed to.
Yeah, I think the latter there, being allowed to, is probably a bigger factor than we all may have supposed there. But yeah, I've said many times on this network about the impact of the fewer players in this space. I think we're starting to see some of that. The stress test is not one I've seen documented a lot before. I need to kind of look at that a little bit more. It's an interesting idea. I'm not sure if that's the biggest driver. I think the lion's share of that is coming down to the fact of what we just discussed, that there are fewer players out there, there's fewer inventory available for these puts, so that by definition, unless something changes, unless a horde of new entrants enter this space and begin offering more inventory on those S&P puts, I kind of agree with you. I think this is kind of going to be the shape of things going forward. But who knows? Stress tests probably don't help, certainly in that scenario. But an interesting notion. And again, listeners, if you're intrigued at all by these concepts of volatility skew and things that we're talking about here, by all means, check out our archived episodes where we get quite a bit into volatility and things like the VIX, as well as, of course, our options bootcamp program and our volatility views program, where we get into things like volatility skew on a weekly basis. All right, now we're going to move on, because it is our final episode of the year. I think it's time to look back on some of the interesting topics and trends and things that really caught our eye, as well as really fascinated you guys, our listeners, here in 2015. So without further ado, it's time to roll on into our Tricks of the Trade segment.
And now it's time for practical tips on how to implement options into your practice. It's time to learn the tricks of the trade.
All right, everybody, welcome to the Tricks of the Trade segment. Doing things a little bit differently this episode. This is usually we break down some sort of great platform or tool, or as the name implies, tip or trick that you guys can utilize in your practice when using options and derivatives. We're going to change it up a little bit this episode and instead use this segment to kind of look back on the year that was 2015 and what a year it was from an options and derivatives perspective, particularly looking at this audience, the advisor asset manager audience. There's been a lot of big trends, big stories that really fascinated a lot of you. I'm going to start off with some of my top ones and the ones we collected here as a team, looking back at the shows we did this year and a lot of your feedback on those shows as to what really grabbed your attention. I'm going to kick it off. Actually, we have a top 5 here. I'm going to actually add a 6th, kind of an honorable mention, because it isn't really specifically an options or derivatives oriented story, yet it was A, kind of the talk of the advisor space this year, and then B, it seems like options are really the great solution to it, and that is, of course, the rise of what has been loosely called the robo advisor in this space for some time, and this has really been terrifying a lot of the people out there who are at some of the big wirehouses and other places where really they traditionally for years have brought you in. They've asked you your name, your risk tolerance, and they say, okay, 60, 30, 10, next. Those guys are kind of going the way of the dodo because they're not providing a lot of value added. And quite frankly, a robot/machine could do that job probably far better. So advisors really in 2015 need to offer some sort of value added, and that's where a lot of the things we talk about on this show really tend to come into play. Knowledge of things like we were just talking about, volatility skew, how that can impact your clients' portfolios and your hedging costs, how to hedge that portfolio, how to also generate income from a portfolio like that, how to use options in these wide variety of scenarios. You don't need to be a complete options master trading, 1/3 iron condor ratio swaps or things like that. You really need to know the basics, as we've cited many times on this program. You can be far more effective as an options and derivatives oriented advisor as a result. And so for me, this rise of the robo-advisors, even though it's terrifying everyone in the space and we're seeing so many trends and so many startups chasing after this trend, I think this is actually a great thing for the options-oriented asset manager out there because it allows you now to raise your hand and say, hey, look at me, and really make yourself stand apart from the crowd because you're not really subjected to this. We're not seeing a lot of systems being out there to really that can put together great custom overlays or custom strategies for individual clients yet, and it's certainly probably won't for a long time because this is very highly customized work. And so it's interesting stuff, and certainly one that I think is at least worthy of honorable mention on the list. But we'll get to the actual list now, starting with number 5. And if you guys listen to our show over 2015, we've featured some great studies on this show and some of the authors on this program. This was a year of really great data. I know a lot of you guys listen to this program hoping to arm yourselves on some great numbers, some great data you can then take back to your clients when you're having that conversation and trying to overcome that obvious and initial hesitation whenever you mention options or hopefully not the dreaded D word, that you want to use these products. There may be a bit of reluctance there, or maybe with some investors in your fund as well. So having data really helps with that conversation. We saw a number of great studies coming out this year. Earlier in the year, way back at the beginning of the year, we brought on the guys who wrote the CBOE white paper on fund use of options in portfolio management. We had a lot of great conversations with them regarding the findings that they found. Essentially, their key takeaways were that the number of options-based funds out there was proliferating quite a bit, and that options-oriented funds offer competitive total returns, which is a key thing. People always talk about risk-adjusted returns, but as the old saying goes, you can't eat risk-adjusted returns. But as their total return capacity, these options-oriented funds are doing very well. Also, of course, blow the doors off when it comes to risk-adjusted returns and overall lower risk, and they can also generate lower max drawdown. So these are all things that are very attractive to options-oriented type advisors and asset managers. We also saw the OIC update to their Harris study where they found a lot of the data we know here in this space, but it's still nice to see more data on it. Options users, of course, more knowledgeable. They use more risk management tools, and they essentially trade more actively than non-options users. So all the things that make for a great client, the options user has. So they also make great clients as well as great portfolio managers out there. So a lot of great data out there. Ewens, this is your bailiwick here. You're working with a lot of this research and data now in your new Factor Wave venture. Perhaps we'll start with you. Either of these two, either of your thoughts on either their honorable mention the rise of the robo-advisor and the efficacy of options is perhaps fighting back against that, or also just this year being a great year from a data perspective in terms of the efficacy of options. Of either your thoughts on either of these being the top trends of 2015 for this audience, or maybe you have a counterpoint to both of those.
Oh, well, to me, the robo-advisor is the big one. And I think a lot of RIAs are nervous about this, and frankly, a lot probably should be, but not the good ones. I think this is an example of where you will get paid for knowledge. If you add knowledge and add something above just a basic asset allocation model, I don't think you really have anything to fear. The robo-advisors are essentially implementing a basic asset allocation model circa 1960, 1970 in terms of, the academics behind it. There's a lot that you can do on top of that. Even simple things like knowing when to tilt your portfolios to value or tilt them to momentum can really add a lot of value to a client's portfolio. And then when you get into options, the robo-advisors aren't going to touch that. Most of the option screeners available don't even really consider directional parts to the bet. Because as you know, if you're trading options, you're really trading volatility whether you think you are or not. And a lot of the option screeners only focus on the volatility, but that's not the important part if you want to own the stock or you do own the stock. Then you have to focus on the fact that, look, I own Apple because I think it's going up. So given that I own it, what do I do now? And your basic option screeners aren't really going to tell you that. And I think that's coming to terms with those sort of things is where a good RIA can really help his clients. And there's a lot of return you can add by doing stuff like that.
Randy, same question to you. Your thoughts on either our honorable mention pick here, the rise of the robo-advisor, the much talked about robo-advisor, or indeed, particularly for this audience and this show, just the proliferation of great data we saw this year in particular. I know some of these studies even included your defined risk systems there. So I think a good, useful year for you guys on the study front as well. But which one of these caught your eye, and maybe like you, and maybe you have an alternative suggestion as well?
Well, we love the research that was done. I think that's those tools are great to promote what we all think on this radio show is some better options, pun intended. So fundamentally, we go back to education of the client base, of the advisors and investment community out there to show that there's improvements to that basic maybe asset allocation modern portfolio theory that is decades old, and say that's part of the solution, that's not the old solution. I do agree about the robo-advisors. Usually every industry is kind of in a phase where you've got to stay competitive or you're going to fall behind and eventually be out of business. So the advisors, I think fundamentally the good ones that need to provide value need to go back and basically make sure that they are truly providing value to their clients. And I think one of those is getting into alternative investments that are not going to be covered as Ewan said earlier, those are not going to be covered by the robo-advisors. I do think that the robo-advisors, although it's a good disintermediation in terms of maybe some of the players in the market, is somewhat based on a flaw in the sense that think that you can just invest in markets, set it and forget it, and everything is going to work out, and you're going to end up with your rate of return. Because what that doesn't take into account is people's emotions, which I think drives a lot of mistakes by investors that allow them to get returns that are substantially lower than they would had they, quote, stayed the course during market turbulence. I always go back to, people, everyone says they want to buy low, sell high, but the reality is they do it just the opposite. They buy at the high and sell at the low. And I think market environments like this are kind of proving that out, where people start chasing the momentum stocks and they ultimately doesn't really work out for them in the long run. So that's my 2 cents on the whole robo-advisors. And just to finish up on the studies that have come out, we love it. We like more attention in the industry. Obviously, we think there's a lot of room to grow in this industry because we obviously do believe that advisors that use options are providing value to their clients that they're not normally going to get.
Yeah, speaking of studies, I'm really hoping myself that there is a study coming in 2016 that kind of quantifies what we were just talking about there, perhaps the impact of the loss of liquidity providers, of major players in the derivatives world, and the impact on products like skew, and maybe on just things like the structural level of volatility in the marketplace going forward. Because I think it's a contributing factor to both of those things. and I know talking to a lot of the people at these different conferences like RMC and others, that's definitely a big area of thought going forward. So I'd imagine we'll see some interesting numbers, and hopefully we'll have some great data that we can discuss on a future episode in 2016 on exactly what's going on in that side of the fence as well. Moving on to our number 4 list here, a number 4 item on our top 5 list of big trends for this audience in 2015, and it seems like you couldn't open up any sort of financial media publication or turn on your television or read anything, particularly things that are aimed at this audience, without talking crude, talking Texas tea. It was definitely the year of crude oil. Of course, a little over a year ago, we started seeing the pronounced sell-off out there in crude land. We dipped below 100 and never really looked back. Over the course of the year, we saw a lot, speaking of volatility skew, we saw a lot of swings in the volatility skew out there in crude oil options. It seems like we saw the first big really build up in the upside of the skew around the 60 handle. When crude was got around there, everyone thought, okay, this is the bottom. We're definitely going to bounce off here. And a lot of people loaded up on bullish positions in the futures and in the options. They, of course, got horribly slaughtered as the product continued its inexorable slide to the downside. We saw some interesting reversal of that recently out there in the crude product about a month ago or so, where we saw a pronounced premium to the puts out there. Even with the product trading around 45 or so in the lower 40s, we still saw people aggressively buying puts as far out as December of 2016, showing that people really viewed this as a structural phenomenon going forward. It wasn't going to be a near-term blip and the product was going to reverse. People were concerned about downside in crude all the way out to the end of next year. And of course, over the subsequent month, we saw that play out in the marketplace. Crude now hovering at or near 11-year lows, depending on which product you're actually looking at. So all this concern to the downside may have seemed overblown, but at the end of the day, it proved to be correct. And now, of course, as a result of all this movement and all these developments out there in the realm of crude oil, we here at the Options Insight have never fielded this many questions in our entire 9-year history regarding crude options in particular, how to use them, how to combine them in portfolios, how to use them on behalf of clients, how to use them as an end retail guy, whatever different side of the fence you fall on. It seems like all of you were fascinated with crude this year, and it doesn't seem like that's going to go away anytime soon, just given the debate that is raging now over whether this is a longer-term phenomenon or we're going to be bouncing back sometime soon, and just all the other factors that go into crude. It's a global macroeconomic concept at the end of the day in discussion, not just a simple one here. So there's a lot of factors that weigh in on it, and it doesn't seem like it's going to be changing anytime soon. Certainly given the vol skew out there in that product, they're still buying it all the way out to D's of next year. So it looks like we're going to be talking about crude probably into 2016 as well. And maybe I'll combo number 4 with number 3 here as well, getting another kind of product-focused, or in this case, really a Greeks-focused conversation. This was also the year, particularly the latter third of it, was the year of the Fed, the impending Fed rate increase. So as a result, we were inundated with questions from you guys out there in this show and others regarding things like Roe. And quite frankly, we haven't talked about Roe in the better part of a decade because rates haven't moved in the better part of a decade. So all of a sudden, the flood of interest in not just rates products, rates options, rates futures, but also on the impact of interest rates on options going forward has been a huge topic of discussion, certainly in the latter portion of this year. And so the combo of those two seem to certainly be the two product areas that really caught the most interest this year. Randy, maybe we'll start with you. Your thoughts on either of these, the explosion of interest in crude? I know you guys are looking at ways to apply the DRS to other assets, I believe, including the commodities like crude, as well as, of course, our collective obsession these days with all things rates and how that played out from an options perspective as well.
Sure. Yes, we do. We do play. We do not play on the oil market, but it is definitely an interesting play. I have more of a political comment, actually. I just remember the days when oil was so high and all the political commentators and TV announcers were talking about investigations into the oil and gas companies and excess of profits, and there's massive manipulation going on in the market. I don't really hear those calls anymore, so it's kind of interesting. I mean, outside of that, I think the only comment I have with respect to oil is, obviously, I think this is negative for the economy. that oils seems to be a leading indicator in terms of the way down. Interest rates aren't high enough for me to really have a big opinion on row at this point. I don't know, maybe you guys have a different view, but I'm not too concerned at this point in terms of any real implications.
No, it's not really row time yet, but it hasn't stopped people from writing in about it and then asking questions about it. So row is certainly on the mind of the audience, which means it has to be on our mind as a result as well. Ewan, same questions for you. Either of these two topics, did you find yourself getting pulled into the gravitational well of crude this year like everyone else, and maybe perhaps also towards the latter portion of the year, starting to find yourself getting lured into the interest rate realm and all the ramifications therein?
Well, to take the second part first, I have to agree with Randall that, row at these levels, I mean, the Fed may have changed its target by 25 bips, but I don't think any of the clearing firms would have raised their financing charges by 25 bips at this point, because they probably already had that priced in to a certain degree because they're pricing it off the forward curve. So I think if anyone's really worried about row, it's always been one of the least important Greeks. I don't know anyone who's ever gone bankrupt because of row, and I think they've got plenty of time to do some reading to find up about that. I mean, they should, but it would be, and always has been, the Greek that gave me the least amount of stress. With regard to crude, I find it interesting as a commodity because it's the one that people see most in their everyday lives. You pass gas stations every day, you see the price of crude reflected in those gasoline prices. But I think it's actually a much more complicated product in a lot of ways than most others, because how it relates to the economy and how it relates to the stock market is very context dependent. I mean, for example, in 2007, 2008, when it went up enormously, we were told that was a terrible thing for the economy. When it came down this time, we were told that's a terrible thing for the economy. And in both cases, those things were right, but it just depends on why the price has gone up. Is it gone up because, in this case, there's probably low demand for crude? Or has it gone up in that case because there was geopolitical problems with the supply? And I think this is a thing generally with commodities, is genuine knowledge is involved whenever you're talking about a commodity, and every commodity is different. So you might be an expert in crude, but know nothing about nat gas. Whereas I find with equities, you can approach them much more as a statistical sort of beast. If you can trade options on Google, you can probably trade options on Apple. So I don't want to give any specific comments on crude other than it's very context dependent. And a lot of the people who'll be giving pronouncements on it may not be worth listening to. I would only really listen to a specialist in crude.
Yeah, it's been interesting. Yeah, that was a good comment about row. It's true. I can't recall anyone blowing out from excess of row. Not to say it can't happen, but that's not exactly the Greek we all run screaming to the hills as a result of. It tends to be Vega and also Gamma, its evil counterpart out there. But still interesting stuff. And yeah, in our audience, asking about row all day long and more, and even row in ways they don't really understand. They want to know about the impact of interest rates as a result on options pricing, things like that. So it's been on everyone's minds, and you're right. It's only 25 basis points at the end of the day. So I mean, I've been saying for the better part of this year, it's not really that big of a deal. 25 bips, not really going to rock the world, particularly if you're out there trading in weeklies or monthlies, which is the lion's share, particularly of the retail audience, and also a lot of the asset managers out there, because they're writing a lot of premium covered calls, et cetera, are usually playing in that spectrum as well. Row is never really going to be a big factor. If you're playing where Randy is out in the 2-year plus spectrum, then row becomes a little bit more of an interesting factor, and how the markets are pricing in future rate increases, not just this one, is really what you're concerned about. All right, getting into our final couple of topics here, top trends, top stories for 2015. Number 2 is one it seems like probably could be one of our stories every year, but it certainly has been a big narrative this year, probably due to a lot of the facts we discussed earlier on the program, the overall increasing structural level of volatility perhaps in the marketplace, the perhaps structural increase of skew in the marketplace, and as a result of those factors, and also just the volatility of volatility. We've seen vol move around quite a bit this year, including just the past week or so. A lot of you guys have been writing in with questions and comments and just downloading our shows on these topics in extraordinary numbers, because this is the topic you guys want to know about. And it has been, just the general impact of rising and or vacillating volatility on options is certainly a core concept for all options-related stories, and it's really hard to avoid it this year. You can't pick up any publication, like we said, or anything options-related without seeing some mention of the VIX, aka the Fear Index. And either it's too high or it's too low or it's moving quite a bit and has changed quite a bit. Those three different types of stories seems like they're interchangeable in terms of one of them will be at the top of one of the publications on any given day, pick the day. And so the impact of vol, of course, an important topic we've touched on many times here on the show this year, and certainly is one we'll probably be talking about a lot going forward. Maybe Randy, we'll start with you. Just in general, kind of the rise to prominence yet again of volatility in all of our discussions in 2015, and probably it's going to be on our radar again in 2016. Your thoughts on this inescapable topic here on the program in 2015?
Well, I think talking about volatility is a lot like talking about the weather. There's always something to say about it, and it's always changing. So from that perspective, I don't expect anything earth-shattering. I think it's too early to know whether or not if this is a kind of a precursor, what happened in August and September to next year. But definitely, we like the more volatile markets for our strategy. So we're happy about that.
That's true. It's good marketing for you guys there to have a defined risk type strategy in a relatively high vol environment. That's what I imagine that's when people come knocking on your door to ask more about these types of things. So probably a good thing for you guys. And of course, you have some short vol components in there as well. So it's an interesting time for you guys. Ewan, this is, of course, your bailiwick, your neck of the woods. You spent a long time as a volatility-oriented risk manager. Your thoughts in general, what we're seeing out in the vol space right now, like I mentioned, the volatility of volatility, the epic highs, the low lows, the doldrums, etc., and perhaps just what we're seeing now, as well as this is probably going to be a story that's going to be ongoing in 2016 as well, I'd imagine.
Well, yeah, I like the comment of Randall's that volatility is like the weather. I mean, a few years ago, I was at conferences and the topic then was, is volatility always going to be this low? And now we're hearing, is volatility always going to be this crazy? And I mean, the answer to both of those is probably, well, no. I mean, things will sort of go back to how they always have been, because that's the thing about volatility. It's relatively predictable in the long run. And if you look at the VIX right now, it's about 17. If I didn't know anything about the VIX when I walked into a room, that's about where I would always guess it would be, between 16 and 19. And I think people are overreacting to the craziness we had in September. I mean, they were the biggest moves in the VIX ever. So that's not likely to be normal, just because, the biggest of anything is by definition not normal. So I think we'll probably, just go back to the way it's been. People tend to have forgotten the first half of this year already. Volatility was very low and just kind of meandered down. It was the second half this year, granted, the volatility of volatility has been crazy, which, by the way, will also drive up the price of those puts, because, there's a mathematical effect linking volatility of volatility to the price of out-of-the-money options. But I would say we're probably in a abnormally high volatility of volatility regime, but the level of volatility to me looks pretty much where I would guess it would be.
Yeah, this is the story that will not go away, and you're right. It depends really where you fall on the marketplace. When vol is low, the premium sellers are always lamenting, saying I'm not getting paid enough for my risk, and vice versa. When vol gets perceived to be high, then the premium buyers, the put buyers out there are saying I'm paying too much. So there's always someone unhappy with the level of vol, but it seems like the vol of vol has really been the story this year, particularly in the latter portion of the year, and how that's really caught a lot of people's eyes as to how this thing is just rocking and rolling. And you're right, epic levels, historic levels, and perhaps not something we'll see again, but it seems like we're in a new structural regime here and probably going to be seeing a little bit more volatility rather than less going forward. If all these other things we've been talking about, if these other factors are going to continue to play out in the marketplace, and it certainly seems like they are. All right, and the number one story we saw for this year, particularly when it came to this audience, you guys wrote in the most about this. We saw the most spillover in terms of our other audiences writing into this program and others asking about this topic, people on the basic retail spectrum writing in, asking what is going on with this, people, retirees writing into us asking what is going on with this, people I haven't heard from in years writing into the network saying, hey, Mark, what is the deal with this? And of course, you guys in the advisor asset manager space asking about this. It was the fallout, the turmoil, call it what you will, in the use of options in an IRA account this year. This was kind of all started, this brouhaha really started with that Department of Labor exemption for fiduciary proposals where they listed the assets that you could essentially use as a fiduciary in an IRA, and the one thing they didn't list was options. So as a result, they effectively banned or really cracked down on their use of options in retirement accounts as a result. And we all know, particularly for this audience, that is an enormous use case for options. A lot of the clients you're handling and all of the funds are using assets in retirement accounts. They're writing calls in IRAs, they're buying puts in IRAs, and vice versa. Some studies have put it up to about 15% or so of ADV is directly attributable to flow in retirement accounts from an options perspective. So this is clearly an important story for this audience, and clearly for you guys. It was huge. We, of course, had Joe Corcoran from the OIC and their lobbying team coming in from the Hill to talk to us about the updates. It seems like now it seems to have settled down a little bit. The Department of Labor and those guys got the message because you guys overwhelmed them with your response that you want to use options in an IRA. But it was, I can't recall a story, a topic for this audience really spilling out to a wider audience as much as this one has in 2015. Hopefully it's a done deal. Hopefully the story we were just talking about, the crackdown on derivatives use in levered funds, isn't going to be the next big one, but that one's open for comment now. We might see. But at least that one's too new to really make this list yet, but maybe that 2016 list. But in terms of the topics that really captivated our audience in 2015, this was far and away the number one. Randy, you were part of all these discussions and debates here on the show. In general, your thoughts back on this kind of whole brouhaha that resulted, and hopefully the fact that it's a settled issue now. We won't have to talk about this in the future, but you never know with these regulatory proposals. It may rear its ugly head again in the future.
Without repeating the whole statement about freedom and stuff like that, I think this goes back to the government trying to come in and trying to protect people, have a very noble goal, but it always doesn't end up in the right place. And I think that we kind of escaped out of this deal without any really big consequences, but I think it got a lot of people riled up, and as they should be providing their opinion to allow people ultimately to have more choices. More to me is always better than less choices.
Yeah, people were legitimately angry about this one. Volatility, other things, there was questions, Roe, they were asking questions. People were fired up about this, which was kind of interesting for us to see that level of furor over a topic. Ewan, this is not really your bailiwick, but I'm not sure, you probably noticed this, just the kind of general level of tumult over this, and your thoughts, again, kind of getting back to the regulatory issue and some of the unintended consequences. Hopefully we've seen the last of this, and a lot of the new users and users to come of your platform will be able to use your platform for their options and IRA accounts going forward.
Yeah, I agree with Randall here. It's like more freedom's always better than less freedom. I think instead of banning these things, the government could possibly do it better by making people disclose the risks involved better. For example, with the leveraged ETFs, yeah, I know they're risky, but if you just explain what the risks are in a more transparent way and let people lose their money if they feel like it. It's like the prospectuses are written in a very, very complicated legalese. So I would rather the government just warned people and then, let them get on with it and make their own decisions.
Well, we're going to have to leave it there because, unfortunately, that's all the time we have for this episode of The Advisor's Options. Also, our final episode of 2015. It was a great year. You guys really flocked to the show and, indeed, flocked to the product quite a bit in 2015. We're looking forward to many more great episodes and conversations and guests and interviews and all, of course, your feedback to come in 2016. But before we go, let me check back in with each of my cohorts here on the program and see what they have cooking that may interest you. Ewan, we'll start with you as our guest. You're obviously in the process of launching this new venture, Factor Wave. Where can our listeners go if they want to learn more about what you guys are doing?
Well, if people go to our website, www.factorwave.com, they can see where we're going. They can download our white paper. They can play with our screeners. We're trying to sort of look at the world through factors like value, quality, momentum. We'll soon be adding options and futures strategies. And if anyone wants to comment or get in contact with us, they can find a way to contact us through the website as well.
There you go. We always like more tools, more platforms, more offerings that make the options product and indeed derivatives as a whole just more penetrable, more accessible to the end user, whether he's Joe Retail or whether he's the advisor asset manager or somewhere in between. I think all of them could use a little bit more access, a little bit more knowledge, a little bit more resources when it comes to these products. And so that's why we like stuff like yours. Ewan, we'll keep an eye on it as it unfolds. And of course, Randy, you guys over there at Swan always have a lot of stuff cooking. You know, our listeners, we've mentioned before your website, Swan Global Investments. I don't think maybe some of our listeners who haven't been there before may not know there's a lot of stuff going on over there. Aside from explaining the DRS and everything else you do, you actually have a lot of content up there. I was just surfing it before the show, actually, today. You have a great post up there from, I believe, just this week about the mathematics of diversification and how these numbers actually play out in the marketplace. Different things about withdrawals and drawdowns. You have a blog. You have a lot of great resources, of course, the good, the bad, and the ugly. So people should be surfing over there if they just wanted some great content. Maybe they want to arm themselves with a little bit of data about, like we just talked about, correlation or other things that may be of interest to the asset manager audience out there, as well as to their clients. So I'd recommend heartily that they surf on over there. You even have some videos coming up over there, so a lot of great stuff. But in addition to all that great content, what's coming out of the pike from you guys over there at Swan you'd like to mention to our listeners?
Besides the stream of content that you had mentioned, hopefully next time we do our radio show, we will launch the official launch of 2 new mutual funds, one based on the small caps and one on foreign developed. I don't see a reason why it shouldn't happen by the end of this year, but next show I'll come up with the symbols and show that we've actually launched. We are actually going to publish something that's going through compliance right now. I think the title is Solving the Gordian Knot, about the retirement conundrum in terms of how you deal with the mass exodus of people starting to retire and how they make their dollars count in retirement and to actually outlive their assets. So we think that's a great piece that we've been working on over the last month. Mark Odo, the rest of the investment management team, and myself have been working on that to kind of outline what people's options are going forward and what's the best way to solve those problems.
Yeah, a big issue facing the advisor community coming up in 2016. We didn't have a chance to get to it on this episode, but it certainly is one as we're shifting from the benchmark-oriented era, comparing to the S&P to now to some of the other use cases they have for these assets as they are indeed retiring. So a big shift coming in 2016 and beyond for the advisor community. And we look forward to getting into that, as well as all the other great trends on future episodes of The Advisor's Option. On behalf of Randy and Ewan and indeed myself, I want to thank all of you out there in the listening audience who downloaded our program and sent in so many great questions and comments throughout 2015. And we're looking forward to many more episodes of The Advisor's Option in 2016.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. This program